Hello and welcome to today's episode of QuickBooks Tips and Tricks. My name is Caleb Jenkins and I lead cloud accounting at RLJ Financial Services. My email is caleb@rljfinancial.com. You can visit us on our website at www.rljfinancial.com. I was recognized as one of the top 10 QuickBooks ProAdvisors and the top up-and-comer ProAdvisor by Insightful Accountant. I was recognized by CPA Practice Advisor as one of the top 40 under 40 in the accounting profession. I was the Philanthropic Practitioner Excellence Award winner by Accountex USA in 2016. I was the youngest pro-advisor to ever become certified at age 16. And I am a volunteer for the Christian Ministry SALT program and a volunteer for the Lamb Services Prison Ministry program in California. For today's agenda, we will be covering the chart of accounts, assets and liabilities and equity, cash versus accrual bookkeeping, measuring profitability, and entering journal entries. Here is what the chart of accounts looks like inside of QuickBooks. So we have our bank accounts and our assets and etc. all listed in a categorical level. So let's do some explaining here to find out what these different types of accounts are. To begin with, I'll start with assets. There are bank accounts, which includes your checking accounts, savings accounts, petty cash accounts, and etc. Asset accounts or bank accounts are used to track your cash accounts, any of the ones that I described above, and to track your flow of cash in and out of the business. The second type of an account is accounts receivable. This is to track the money that others owe you from outstanding invoices, and this is called accounts receivable, or AR for short. Another type of account under assets is other current assets. This would include your inventory assets and your undeposited funds. This is the description for this would be to track your intangible assets that have a life of less than 1 year. Then there is the category of fixed assets. Fixed assets are used to track tangible assets that have a useful life of more than 1 year. And then we have other assets. Other assets are used to track intangible assets that have a life of more than 1 year. So to break those down again, you have bank accounts, accounts receivable, other current assets, fixed assets, and other assets. Those are all asset types. We will debit assets to increase the value, or we will credit assets to decrease the value. Then there's liabilities. Liabilities have multiple account types also. There's accounts payable. This would be the reverse of accounts receivable. This would be the money that you owe others from outstanding bills, and that is called accounts payable, or AP for short. Then there's the account type of credit cards. Credit cards are used to track the charges and payments against a credit card. And then we have an other current liabilities account that is used to track the debts that have a payoff period of less than 1 year. So if I borrow money from somebody and I pay it back I'm supposed to pay it back within 1 year, I would use the other current liabilities account. Long-term liabilities is another category, and that's used to track debts that have a payoff period of more than 1 year. So if I go borrow money from the bank and it has a 30-year life, that is a long-term liability because it's more than 1 year. So that is liabilities, which again includes accounts payable, credit cards, other current liabilities, and long-term liabilities. If I want to increase the value in liabilities, I have to credit. Or if I want to decrease my value, I use a debit. Equity it includes multiple types of accounts, including common stock, owner's investments and draws, opening balance equity, and retained earnings. The equity account holds the owner's interest in the business after all liabilities are paid. Now, to calculate equity, we do your total assets minus your total liabilities equals your equity. Equity is typically referred to as what you are worth if you sold all your assets, paid all your liabilities, what are you worth at a business level? Let me describe cash versus accrual bookkeeping really briefly here. Cash basis bookkeeping is when you record the income when it is received, and expenses are recorded when the money is paid. In other words, income and expenses are recognized based on the date money changes hands. So in essence, cash basis bookkeeping tracks nothing in regards to accounts receivable and accounts payable. It is only cash in the sense of when money is received from a customer and when money is paid to a customer. Accrual basis bookkeeping, on the other hand, would be income is recorded at the time of the sale and expenses are recorded when you receive a bill. So in other words, income and expenses are based on the date of the paperwork. Accrual basis bookkeeping is the most accurate form of bookkeeping because it truly reflects what happens in your business. Now, however, it requires more work because you have to record the income through an invoice and track your accounts receivable, and you have to record your expenses through a bill, which is accounts payable. So you have to keep more detailed books through accounts receivable and accounts payable. That is accrual basis bookkeeping. Now to measure profitability. The balance sheet is what records your assets and your accounts receivable, your liabilities, your accounts payable, and your equity. Your profit and loss is what records your income, expenses, and your profit. And then your statement of cash is what records your payments and receipts to show a particular date range. So let me break that down for you. The balance sheet is, it could be described as a picture of your company. So if I take a camera and I take a snapshot of your company, that is what the balance sheet would show. It shows what you look like as of a certain date when you run the balance sheet. So it shows you both what you have and both what others owe you. That's your assets and accounts receivable. It shows what your company owes to others. That's liabilities and accounts payable. And then it shows the net worth of your business, and that is equity. The profit and loss, on the other hand, could be described as a movie of your company. The movie would be you have a start date and an end date. So I want to see what my business looked like over that date range. So it would show me my income, my expenses, and then my net profit, which is my income minus my expenses. The profit and loss is very helpful to know how your business did. The balance sheet is very helpful to know what you look like at a certain date. Now the statement of cash flows would show you how your cash, where your cash went during a certain time period. So you received $100,000. Where did that $100,000 go? Because it's not in my bank account anymore. So the statement of cash flows is also very helpful. The final thing that we'll cover here today is making journal entries. To do this in QuickBooks, we will go to Company and then Make General Journal Entries. This is what the screen looks like inside of QuickBooks to make a journal entry. To do this, we will enter an account, and then we will enter a debit or a credit, and then a description in the memo field, and then an offsetting entry for the debit or credit. So if I'm going to debit my bank account to increase the value because it's an asset account, then I will put that in the top line, I'll give it a description, and then I want to credit my income, or I want to credit my income and enter the income description. That it would be a debit, say of $100,000 to my bank account, and then a credit to my income for $100,000. Your debits and your credits have to balance out. Now, what is a journal entry in accounting? A journal entry is to record transactions and using a double entry accounting. Double entry accounting implies that transactions are always recorded using two sides, a debit and a credit. The debit refers to the left-hand side of the transaction, and a credit refers to the right-hand side of the transaction, the journal entry. Now, again, the sum of the debit side amounts and the sum of the credit side amounts must equal the same. A journal entry is called balanced when the sum of the debit side amounts equals the sum of the credit side of amounts. So that is making a journal entry in QuickBooks. Thank you for watching. If you have any questions, feel free to send me an email. My email is caleb@rljfinancial.com.